Whether you're stepping into the housing market for the first time or you're a seasoned property investor, securing the right kind of property financing is a cornerstone to cultivating a flourishing property collection. Getting to grips with the diverse array of property finance options arms you with the knowledge to set your financial limits, work out an initial investment sum, and confidently navigate through the conversation of borrowing possibilities with your financier. Basic real estate loans. 1. Conventional loan, fixed-rate mortgage. Traditional loans stand independent, not backed or insured by any government entity. Their terms are typically locked in place, offering stability over periods like 10, 15, 20, 30, or even 40 years. With consistent rates, you'll find conventional loans split into two categories: conforming and non-conforming. Conforming loans adhere to the government-set ceilings, generally not surpassing around $700,000. Cross that threshold and you enter the realm of jumbo loans, which operate outside these confines, often carrying steeper interest rates and a more rigorous qualification process. For those boasting a solid credit track record, dependable income, and the ability to front at least 3% for a down payment, conventional loans might just be the perfect fit. Be aware, though, that if your down payment dips below the 20% mark, you'll typically need to budget for mortgage insurance. And if you're finding value in this discussion, why not tap into a steady stream of savvy? Hit subscribe to keep abreast of the latest in real estate investment tips and never miss out on ways to enhance your portfolio. Now let's delve further. 2. Government-insured loans. 3 federal bodies provide support for home purchasers in securing mortgages: the Federal Housing Administration, FHA loans, the United States Department of Agriculture, USDA loans, and the United States Department of Veterans Affairs, VA loans. FHA loans could allow you to put down as little as 3.5% based on your credit standing. These loans necessitate 2 mortgage insurance premiums, one due at closing and another payable annually if your down payment is less than 10%. Expect to carry private mortgage insurance, PMI, until your equity reaches 20% in your property. VA loans cater to the United States military service members, both active and retired, and their kin. These loans come without the need for a down payment or PMI, but they do include a funding fee, calculated as a percentage of the loan amount. USDA loans are tailored to aid those in rural, USDA-eligible regions in obtaining home financing. For qualified income levels, some USDA loans might waive the need for a down payment. These loans include an upfront mortgage insurance fee of 1% and an annual fee of 0.35%, the latter being paid in monthly increments. 3. Adjustable rate mortgages, ARMs. An adjustable rate mortgage comes with an interest rate that varies based on market trends and the specific terms set by the lender. Several ARM offerings will present a steady rate for the initial years, followed by a shift to variable rates, often subject to a ceiling. If your strategy doesn't include remaining in your home for an extended period, this option could offer savings on interest payments. 4. Interest-only mortgage. Occasionally, a lender may offer an interest-only mortgage where your initial payments cover just the interest for the initial 5 or 10 years. Once this term concludes, the mortgage converts to a standard one, bearing fixed rates. This approach extends the payoff timeline but can be advantageous if managing monthly payments is currently a challenge. 5. Seller carryback financing. During a buyer's market, it's common for sellers to lure in potential buyers with unique inducements to seal a transaction. Seller carryback financing is one such incentive. Here, the seller assumes the role of a bank or lending institution by holding a secondary mortgage on the property, which exists alongside the buyer's primary mortgage. Consequently, the buyer is responsible for making monthly payments on both mortgages. This arrangement might also be known by the terms owner financing or seller financing. 6. Owner-occupied loan. Should the asset be a duplex or a multi-unit residence, purchasers have the opportunity to secure an owner-occupied loan. Here, buyers are allowed to leverage the rental proceeds from the property as a basis for the loan approval, which often comes with increased borrowing caps. The property needs to feature executed rental lease contracts, ensuring that the payment streams can be substantiated. Given their classification as investment properties, private lending entities might ask for larger initial down payments, usually in the range of 25–30%. Moreover, the VA and FHA are open to collaborating with purchasers regarding owner-occupied loans. 7. Agricultural loans. Agricultural loans cater to properties encompassing 10 acres or more and are devoid of constraints regarding owner-occupied versus non-owner-occupied status. This includes lands used for orchards, farms, and vineyards, among others. Various firms issue these agricultural credits for qualifying properties, offering a range of flexible financing solutions. As we wrap up our journey through the diverse world of real estate loans, we've equipped you with knowledge that could significantly pivot the way you approach your investment strategy. With these insights, you're not just stepping into the market. You're stepping in with confidence and an array of options to tailor your property investment plans. And while you're navigating these waters, it's just as crucial to know what pitfalls to steer clear of as it is to know the routes to success. For those keen on continuing to refine their real estate acumen, there's a valuable resource awaiting your click. On the screen, you'll find a video dedicated to real estate mistakes to avoid, because the wisest investors are the ones who learn not only to seize opportunities, but also to sidestep potential setbacks.